If you've been investing for some time and want some capital preservation, or you're going to start investing in 2026, starting the new year, just like people start the gym, and you want to know how you can preserve your capital and make a decent return while not risking a lot of money and make some investment return like I have done, as you can see here, then stick around. This video might be for you. Now, these are just my ideas and my opinions. By no means should you do exactly what I say in this video. This is just to give you a general idea so that you're able to make a well-informed decision and you do what is best for you. I still suck at investing. My portfolio is still considered very small. However, I did make a return of about 33% all time that I've been in the portfolio. So maybe these tips could help you. Now, this is going to consist of a 5-fund investing portfolio, which some of the goals with this portfolios are going to be to diversify as much as possible, to cover different sectors. Of course, to diversify. It's not going to be a very high risk portfolio. It's going to be around medium risk. It depends on your age. You can adjust what percentage of your portfolio you want each ETF to be. Of course, we want capital preservation. We're going to have some bonds in there. The way I'm using this is for my retirement. I do buy some individual stocks, but the core of my portfolio in my other account is going to be ETFs. And it's just an easy investment, man. You don't have to do a lot of research. This is already done by smart people that invest a lot better than I do. And throughout history, it's shown that ETFs, not all of them, but a lot of them, like the S&P 500 or the Vanguard total market ETF, they tend to return at least over 10% over a 10-year period. Now, I'm going to giving you two examples, more of a high risk one and more of a conservative one. We're going to start with Vanguard VUG, which is Vanguard's growth ETF. As you can see, I currently do have this in my portfolio. It's about 28% of my portfolio. That is because I had some sales before the end of the year for some tax harvesting, but I want to manage this down a little bit to under 20%. However, I currently own 10 shares at an average cost of about $477, which is giving me a nice return of 2%, which is about $100. Now, the reason this ETF is a little bit riskier is because it's concentrated, most of it, about 51.28% of the ETF, in technology. So as you know, in the stock market, technology sector is the one that is the most volatile. It tends to move a lot. So your portfolio will move a lot depending on what percentage of this ETF you have in your portfolio. Remember, there's going to be a total of 5. And I know some people think that investing in ETFs might be boring, but however, if you do invest in ETF, you're investing in the best companies in the world, such as Apple, Nvidia, Microsoft, Amazon, etc., and at a lower risk. And something I really want you guys to take a look at is, if you look at the average annual return since 2004 that this ETF was created, it has returned about 12% per year. Now, this doesn't mean that every single year you're going to make 12%. As you can see here, one year you can make 19, the other one you can make 32, the other one you could lose 20, the other one you could lose 30, the other one you could make 50, like that. But through an average since 2004, this ETF have returned you 12%. Now, of course, the next one is going to be SCHD, which is probably one of the most popular ETFs in the past 3 to 5 years, I would say, which is the Charles Schwab's Dividend Equity ETF. This can be considered a growth and income ETF. I do own this in my portfolio. It's about 13% of my portfolio. I want this to be a higher weight. It's at an average cost of $26.65 that I invested in, making me a nice little return of 4%, which is about $104. Now, the whole idea of this ETF is to cover parts of the market that the VUG does not cover, and not only that, give you dividends as well, and also have dividend growth within it, so that every year you're making more and more dividends based on the growth per share that you have. And if you buy more shares, then you're going to get more dividends. Now, as you can see, this is completely different than the VUG. It's a little bit more diversified. It's going to be 20% in energy, 17% consumer defensive, 15% healthcare, and so on. The percentages are a little bit more widespread. And still, you're not investing in random companies. You're investing in very important companies like Lockheed Martin, Bristol Myers, Texas Instruments, Chevron, Verizon, etc., etc. And again, if we take a look at the average annual returns since inception of 2011, this ETF has returned about 12.30%. Keep in mind that this isn't counting the dividends. I believe it is not. I have to do some research in that. So you're making 12% on capital appreciation plus the dividends getting paid out. And one thing I wanted to show you guys, if you use this ETF research tool, you could put in 2 funds and it'll tell you how much of the funds are overlapping. So if you put in VUG and SCHD, you can see that by weight, only 1% is being overlapped. So about 4 stocks are overlapping, which means that you are completely diversified. Okay, VUG has completely different companies than SCHD. This is good because what happens, let's say you hold this until retirement, until you're 65, and then the technology sector is not doing all that well, but you need some capital, to go on vacation. You can go ahead and sell all your SCHD shares, or you don't have to sell it. You can just make the dividend. But in the case you want to, you sell that, and then you wait for the UG to be performing, and then you sell that afterwards. So that's why I want to diversify, just in case there's some risk. I have some options to play with my capital, and it's not all stuck into one sector going down. Now, the next one we're going to be taking a look at is the iShares 2000 ETF, which this invests in small cap stocks or sectors. I currently do not invest in this ETF. I'm planning to add it to my portfolio, but I've been concentrating on selling puts at the beginning of the year and buying some stocks that I do believe that are undervalued. But this fund is divided by 18% healthcare, 16% financial services, 16% industrials, 15% technology. And as you can see here, it's small cap stocks. So you are investing in not so popular stocks, which is also good because again, in 20 years now down the line, if you, let's say you want to retire and then the SCSG is not doing well and the VUG is not doing well, but emerging markets for some reason is doing very well, you can go ahead and sell this, have some capital, and wait for the other ETFs to go up in price or whatever it is you want to do, and then close it out and have your fun in retirement. And again, as we can see, the average annual return is not as good as the other two, but since 2000 it has returned about an 8%, which I consider to be still very good. Now next up is going to be IBIT, iShares Bitcoin Trust ETF. I am not personally investing in this ETF, but I am buying some Bitcoin almost every week, about $5-10, nothing crazy. I just want to be exposed to it. So basically this ETF just seeks to track the price of Bitcoin, and instead of you putting $10 and only owning 0.00001% of Bitcoin, you can buy this ETF and you'll probably get better returns. As you can see, I did own this in the past, but I decided to sell it. I didn't really have a need for it. I bought it at 26, sold it at 34. It was just one share, so I decided to just close it. And then of course, this is not going to be very accurate. This is the average annual return. This hasn't been open for more than 2 years, I think. Yeah, since January 2024, and it has returned about 41%. This is going to change, of course, throughout when you see 3, 5, 10 years. Maybe it's more, maybe it's going to be less. I don't know, but it's definitely going to change. And then the last on the list is going to be iShares 3 months treasury bond SGov. I am invested in this. Is about 30 shares, which is equals to 17% of my portfolio. The whole reason I have this is so that my capital could be preserved and I have some cash making money whenever I have opportunities in the other ETFs like VUG and SEHD. So for example, I have $3,000 here right now. Okay, let's say that VUG drops below my average cost that it was, I believe, 477. I can sell this instantly and go and buy VUG. And this is still returning me, I think it's about a 3.4% or something like that. I have to take a look at it. Of course, this doesn't move a lot in price. So since 2020, you're only making about 2%, which I mean, you're still increasing your capital. And as you can see here throughout the history of the portfolio, you can see I'm getting paid dividends. In December, I got paid $8 in dividend, again $7, $6, and so on and so forth. So I'm getting paid dividend. My capital preservation is good. As you can see, it's only moved about 2%. I'm still getting increase in my capital. And again, the dividends are great. So this just adds to more money that you can buy the other ETFs. Now, if you think the VUG is a little bit too risky and a little bit too volatile for you, you can always go with the Vanguard 500 ETF. Now, keep in mind, this is going to overlap a lot more with SEHD, as this covers the top 500 companies in the S&P 500, which some of those are already in SEHD, but it's not that crazy. As you can see, the total overlap is going to be only about 7%, which is a total of 42 companies that are being overlapped. Now, this fund is also heavily invested in technology, but it's only 35%, so about 20% less than VUG. And again, it's invested in most similar companies like Nvidia, Apple, Microsoft, etc. And if we take a look at the total return since 2010, is going to be about 14% for this ETF compared to the 12% of VUG. And if you think that having just two different ETFs like VUG and SEHD is completely nonsense, you can also go ahead and just buy the Vanguard Total Stock Market ETF, which you're going to invest in every single company in the stock market. You can keep this one, you can keep the EBIT, and then you can keep the SGov, and you also have a very well diversified portfolio. The only thing is you got to keep in mind you're concentrated just on this ETF. So yes, if the technology sector is not doing bad, the ETF is not going to move that much, but you're not going to be able to sell some parts of it like small caps or medium caps and keep that capital that are doing well at that time. So that's why I prefer to separate them and not invest in something like this. This is definitely something I would invest in, like my Roth IRA or my 401k. But in my investing portfolio, I'd rather have some options in the future if I want to move my capital or rebalance my portfolio. I want to be able to sell the mid caps, the technology stocks, the small caps, whatever it is I want to do. I want to have at least some control of my portfolio. Now, again, this one is also very heavy on technology, about 33%. Again, the same companies, Apple, Nvidia, Microsoft. And if you take a look at the overall return since 2001, it's going to be about 9%. So let me know which of these options did you like best, and also if you were to build a 3-fund portfolio, what would they be if you have different options than this? I'd love to hear your thoughts in the comments. As always, guys, if you enjoyed the video, please consider leaving a like. Don't forget to subscribe, and I'll see you on the next video.